Hello and welcome to Cedarstone's presentation on slowing growth. This is Matt Davis, Vice President here at Cedarstone, and I'm going to walk you through some of the economic data that is causing world growth to slow down. The good news here is that the world economies are still growing, but we are seeing them grow at a rate much slower than we have seen historically. This is what PIMCO is calling the new neutral, an economic environment that sees us moving more sideways as opposed to up and down. A slow growth world has its own unique set of opportunities, and we will discuss what we think this means for investment returns going forward and what kind of strategy does well in this type of environment. First, let's talk about interest rates. This first chart shows how interest rates have dropped for nearly 30 years. Lowering interest rates are supportive to an economy, but unfortunately, we are getting to a place where rates don't have much further to drop. This doesn't mean we are predicting rates to begin marching upwards, but we do believe that rates will find a floor here and no longer provide a support to asset prices. The Federal Reserve has supported this view as they came out and signaled that rate increases will most likely occur at a slower pace than the market was anticipating. We do not believe that rates will rise fast enough to become a major headwind to investments, but we do believe that the time for falling rates is behind us and that they will no longer support asset prices like they once did. On this next slide, we'll take a look at debt burdens. As you can see over the past couple of decades, debt as a percentage of GDP grew very quickly and has continued to stay stubbornly high in the developed world. As we borrowed more historically, we were able to consume more, which again helped support growth. But as that levels off, debt will no longer help drive growth. Again, this is probably healthier for the economy overall, but does not help short-term growth rates. In addition to flattening debt levels, we also have demographics working against us. In 1990, all 6 countries we have listed here had a growing working population, which helped support growth. The top line is China, followed by the US, Japan, Germany, Italy, and the UK. Today, only 3 of the 6, the US, the UK, and China, have growing working age populations. As we project forward, by 2030, we show only the United States will continue to have a growing workforce, while the rest of these countries listed here will have shrinking workforces and will most likely be a drag on their economies. On this chart to the left, we see GDP growth in emerging markets. The emerging markets have been a significant boost to growth over the past decade, but we're starting to see many of their growth rates slow down as well. Countries like Brazil and Russia have seen many political issues. Inflation has started to creep up in a lot of these countries as well. We also see debt burdens starting to rise in the emerging markets on this chart to the right. This doesn't mean that we think emerging markets are in trouble, but we do think that they're unlikely to support with the same amount of growth as they have in the past. So what does this mean for world growth? On this chart, we explore what PIMCO projects GDP growth will look like over the next year. Overall, we still see positive growth, but a much slower rate than historical averages. Japan and the Eurozone continue to underwhelm at around 1%. Deflation has become a real concern for Europe, something that the European Central Bank has finally come to terms with as they begin executing their own quantitative easing strategy there. We'll want to keep close tabs on that. China looks to continue to chug along at about 6.5%. Definitely a robust growth rate compared to the rest of the world, but again, much slower than they have historically. They've been around double digits for the better part of almost 3 decades. BRIM, or Brazil, Russia, India, and Mexico, continue to put up disappointing growth numbers at around only 2%. Again, with a lot of concerns over inflation in a lot of those countries. Both the United States and the UK are brighter spots in the world with growth around 3%. So what does this mean for future returns? Given lower growth rates across the world, we believe investment returns will most likely be dragged down as well, probably over the next 10 years. PIMCO's market assumptions that they have here have the bond index returning just shy of 3% and developed equities at around 5%. Both again below historical averages. This will mean a balanced portfolio will return probably somewhere in the range of around 4% annual for your typical index investor over the next 10 years. So if we believe that is the most likely outcome going forward, what do we think is the best way to invest? Here at Cedarstone, we believe this kind of economic environment emphasizes the use of carry, or more simply put, this is time to take advantage of low short-term interest rates. As long as the Fed continues to be accommodative because of low growth, borrowing costs will remain low, and deploying capital efficiently becomes one of the best ways to increase return. Our favorite strategy currently is to use an absolute return strategy overlay on our equity portfolio. In the coming weeks, we'll have another video on how this works, as well as other ways to make sure your investments are working hard for you. Appreciate you taking the time to learn about the slowdown in world growth, and please feel free to reach out with any questions or let us know if there's anything else we can be doing for you and help make sure that your investments are growing well in an environment that might be a little bit slower than historically. Thanks.